All right, guys, welcome back.
Yeah.
UIL back home. So yeah, this is going to be a very important episode, something that we always have to cover periodically. Credit, very important topic when you talk about finance, financial literacy, business. And Shonda Martin, somebody that we actually had on a few of our events, but never had an interview. We had an event in Oakland with Chase a few years ago. We did that.
That was fun.
Yeah, that was real fun.
And then InvestFest.
Yep.
You did InvestFest twice, right?
Did InvestFest twice, and we went to Howard.
Yeah. And we went in Howard. That's
We went to Howard, yeah.
Yeah, for sure.
Oh, this is home team.
Yeah.
Sure.
Yeah, it's home team. This is home team.
Yeah.
This is home team.
Yeah. So she's been on the road with us. But like I said, we haven't actually been able to have a formal conversation. I know a lot of people come to the events, but there's probably going to be more people that actually get a chance to view it in this capacity through audio, YouTube, and, social media. So, yeah. First and foremost, thank you for joining us. Appreciate it.
Thank you. Thank you for having me.
No, for sure. So you're a credit educator. I know you're the owner of your company, which is Road to 750.
Yes.
And Credit Academy. So first, obviously we got a lot of questions about credit, but how did this start for you? Because there's a lot of people that say that they do credit, stuff like that. But how did your journey end up to where you are now?
Yeah. So it kind of happened by accident. Like literally, I was in college, and that was the first time I realized I did not have good credit. I tried to get a car. They wanted me to finance it at like 28%.
Damn.
I took it because I didn't even because I didn't grow up learning about credit or knowing about credit. It wasn't a thing. So by the time I realized I had bad credit, it was too late. I was already mid-contract. So when I, went to renew my car, they told me, hey, you can't. You're going to take negative equity into your new loan. You need to fix your credit. And I just went home and I just started researching it. So as I began to like fix my own credit, repair it, and like build, I started like telling my family and friends about it, like things to do, things that were working for me. And it started with me starting a Facebook group with like 10 people just for my family and friends. And that group now has over like 600,000 people, but it started just in that group, me thinking I'm sharing credit information with family and friends. And I ended up going to school for it, changing my major, switching my major, studying it, getting certified, getting board certified. And it kind of just happened like that. I started trying to fix my own, and then I just like became obsessed and fell in love with credit.
28% is crazy. Were you aware that your credit, I mean, obviously it was a surprise to you, but what were the things that you were doing looking back that were negatively affecting your credit?
I think my biggest thing was I hadn't built credit at that point. Like I was always taught no credit cards, cash, buy everything. If you don't have the money for it, you can't afford it. Now I know that of course it's not true, but living that way, caused me to not have credit. And then the credit that I did have, I had like a few collections, just low level like T-Mobile phone bills and stuff like that. But yeah, so I had no credit, and then on top of that I had a few bad accounts.
Gotcha.
Yeah.
So okay. So when did you start teaching credit?
So it started, like I said, with just sharing information, I would say, with my family and friends. I didn't start officially teaching it until I got certified. So I was certified through FICO, and then I went to get board certified as a credit educator. And so that was when I was like comfortable with sharing information. I'm just the type that I don't like to teach or educate about anything that I don't feel like I'm an expert in, especially online, because people crazy. So yeah, I definitely, after I realized like I had a passion for it, I knew that this was something that the people that look like me in my community, I knew that this was something that they was missing. And I knew that I could explain it in a way that they would understand, which is what was like the driving force around me getting the formal education and then like translating it to my audience and people that look like me.
So what is that? Is it a FICO certification?
Yes.
What is that?
They need the program back. But it was a program where you would go through, it was 8 weeks, and you would literally just learn the ins and outs of the FICO score, like how every single point is allocated, how your credit, we had to break down a credit report. I'm able to like look at a credit report and immediately identify any areas of opportunity. Like the FICO course taught you in a way that credit is not being taught anymore. It was just like diving in detail about how every single item affects your score, things that will lend points to your score. And it just kind of took the mask off, I would say, of just credit scoring.
So when we talk about FICO, a lot of people, what's your FICO score? What's your credit score?
Yes.
How does this work? Because we know that there's bureaus, Experian, Equifax, TransUnion, and then there's FICO. Are the scores from those three bureaus average, and that becomes your FICO? So how does that work?
So the easiest way to explain it is we have three separate credit scores. They're assigned by TransUnion, Equifax, and Experian. So those are three scores that you're assigned. Now, when it comes to FICO score and credit score, FICO score is the industry standard. So like if you're purchasing a home, if you're buying a car, applying for a credit card, they're going off your FICO score.
Okay.
The difference is most people are only privy of their Vantage score, which is essentially just like a free version of FICO score. And that is like when you have Credit Karma. Most credit monitoring apps will give you your Vantage score as opposed to your FICO score, which is why a lot of times people will think that they know what their credit score is and they'll go apply for something and they're like, well, Credit Karma was telling me I had a 650, but the car lot is telling me I have a 540. So there are three different credit scores, and to not make it complex, FICO has many different models. So depending on what you're applying for, the lender will choose a different model that they'll pull.
I think I've seen that. So it was like if I needed a loan, it was like FICO score 8. Or if I needed a credit card, it was different bureaus inside of it. And they could be similar or they could be vastly different.
They could be vastly different,
yeah. Because they're graded differently?
True. So the ones that I like to talk about, because I think that everyone should be aware of these different ones, FICO 8 is the one that's used the most. So especially when you're applying for credit cards, some car and personal loans, they're going to use FICO 8. When you're purchasing a home, they're specifically going to use FICOs 2, 4, and 5, which are known as the mortgage scores. If you're purchasing a car, they're going to use your FICO 6, which is your auto score.
Okay.
So those are like the three most used versions or widely used versions of your FICO score. But the way that I teach credit, when you fix your credit profile, it'll translate across all scores, which is why I don't necessarily place too much emphasis on the different versions of your FICO score, because if you have a healthy profile, it'll translate regardless of which score is pulled.
Keep it healthy.
Yeah.
So what factors contribute to your personal credit score?
So your credit score is broken down into 5 categories, right? So most people know your payment history is 35%, your credit utilization is 30%, credit age is 15%, and then hard inquiries and credit mix are both 10%, right? So those are the 5 factors that lend to your credit scores. Now they're weighted differently. So payment history is 35% or worth up to 192.5 points. Credit utilization is worth 165 points. Credit age is worth 82.5 points. And then hard increase and credit mix are both worth 55 points each, right? So those are the separate factors. And when you're building your credit, if you focus on those top 3 categories, which is credit utilization, payment history, and credit age, you'll have at least like a 680, 690, and sometimes even a 700, depending on.
So can you go through each one of those top 3? Credit utilization, explain.
I definitely can. So payment history is the largest factor in your credit score. So in layman's terms, pay your bills on time. If you cannot make a payment, schedule an arrangement with your bank, because the second that your bank reports a late payment, which is a payment that's 30 days past the due date, you will have a late payment. Because your payment history is the largest factor, one late payment can literally drop your score up to 100 points, depending. And so then credit utilization, which is one that's slept on, and honestly, it's the one to me that has the most immediate impact on your score. So what I mean by that is your credit utilization is pertaining to credit cards. So how much you're using your credit card, how much of a balance you carry over to the next month is going to determine your utilization. Keeping that below 10% is going to do wonders for any profile. And then credit age is something that when you're in the beginning of building your credit, you're not really going to have any control over that. As you open new accounts, close new accounts, if you are repairing your credit and you're getting things deleted, that also affects your credit age because it is an average. So after you get your base level credit profile, and we can go into that, don't apply for anything for 6 to 6 to 9 months, and that'll aid to improving your credit age. Because that's the mistake that a lot of people make when they're building credit. The probably the number one mistake.
So what?
Applying too fast, trying to build credit too fast, thinking that anything that they apply for and get approved for, it's a great thing for their credit profile.
So the kid that's walking on a campus right now, he's walking into that CAF, and those companies are waiting for him to give him that $500 card.
Yep.
Or the $1,000 card.
Yeah.
Sometimes $2,000 if they know you, right?
Yeah.
We want to make sure that they're using 10% of that. Perhaps.
So it's not necessarily using 10%. So when it comes to using a credit card, when it comes to using your credit card, most people think that utilization depends on your usage, and it doesn't. Okay. It just depends on what you carry over. And I'll explain that. Utilization is only reported 1 day a month. So it's on your statement date, which is the last day of your billing cycle. Matter of fact, everybody who has a credit card needs to look at their credit card statement and find their statement date. It's the last day of the billing cycle. That date is so important because whatever balance that you have on a credit card, that is what's going to be reported to the credit bureaus and also used as your utilization. Your statement date is different from your due date. So most people get confused because your due date is going to be before your statement date, probably like a week or two prior. So even if you paid your credit card bill down to 0 by your due date, if that balance is not still under 10% by your statement date, then it's not going to be counted as your utilization. It's not going to be reported to the credit bureaus. So identifying when your statement date is and making sure that you pay your balance, pay off at least 90% of whatever you spent during the month, pay off that balance, then you'll be good. Because like if you have a $500 credit card, you can use the entire $500. You don't have to stay below 30% or 10%. You just have to make sure you pay it back within that same billing cycle, which is key.
Okay, so what are the first steps to building good credit history?
Okay, so the first steps I would say is, so I have a base level credit profile recommendation for everyone, right? I say that if you are wanting to build credit, but like build a healthy credit profile that will continue to grow and kind of set you up to get high credit offers and low interest rates and all of that, the base level credit profile. Everyone needs at least 2 credit cards. It needs to be at least 2 revolving credit cards, right? Doesn't matter the limit, doesn't matter if it's subprime, it doesn't matter if it's secured. You can literally get 2 $200 credit cards, right? Make sure that you keep that utilization every single month. You keep that utilization below 10%, right? And then because we have to hit a limit of, we have to hit at least 4 accounts. 2 of them will be credit cards. The third account needs to be a short-term installment. A short-term installment is just any installment under 36 months. Kickoff. Every bank pretty much offers a credit builder loan. And then if you can, get a long-term installment. So if you have a student loan, if you have a car loan, if you have a mortgage, those are considered long-term installments. So if you already have those, you don't need to apply for another one. Just focus on the other 3 accounts. And having those 4 accounts, 2 being credit cards, 2 being installments, short-term and long-term, it's going to, and not applying for anything else. I want to be clear. Do not apply for anything else after you get that those accounts. Don't apply for anything else for 6 to 9 months. And you should be able to get pretty much any credit card that you want. Consider if you pay it on time and, of course, make sure you're not getting collections and other things. But yeah, that's the perfect credit profile that speaks to the credit scoring algorithm and will allow your credit score to grow at the most rapid pace.
Would you put the buy now, pay later companies into that short term, right? Like the Affirms of the world?
It depends, because I see a lot of those on credit reports, and I'm glad you brought that up. A lot of those, people are getting them too often. Like they'll finance a $200 purchase. Any loan under $200 just looks like a low-level loan. It doesn't feed the algorithm of the credit scores. They pretty much kind of look down on that, right? Like, so if you're applying for credit and your lender sees a lot of those buy now, pay later accounts and low-level is what they call low-level accounts, that almost, regardless of what your score is, that's almost to your detriment, because it looks like this person is not financially stable. A lot of people don't realize that their score doesn't tell, like their score is just for a consumer, really. When it comes to like your lenders, they're looking at so much more than your score. There are so many other determining factors of if you're going to get approved for a car, over your score. Like your score tells them nothing because you can falsely inflate your score. People buy trade lines all the time and things of that nature. When it comes to your credit profile, doing things like that, I would not recommend. Not in the beginning, not unless you have an established credit profile with years of credit history, then you can kind of afford to have those accounts.
So, okay. So what's the best ways to use credit cards to improve your credit score?
Yeah, credit cards are my favorite because, like I said, they're like the only accounts that have an immediate impact. Like when you get a loan, you're not really going to see, you don't really see the positive benefits of a loan until you're at least 90% done. So most people will get a car loan and they're like, I've been paying my car on time. Why is my score not increasing? It's because you're very early into that loan, right? When it comes to credit cards, you can see a change in your credit score within like 60 days, as long as you know how to use it. And I would say how I use, we can just use a $200 credit card, for instance, right? If you have a $200 credit card, the first thing you're going to do is identify your due date and your statement date, right? Your due date, you want to make sure that I zero out my balance on my due date, because any balance that you carry over past your due date, your bank can charge you interest on, or will charge you interest on. So after my due date passes, I wait until my statement date, and I make sure that my balance is whatever the credit card limit is. If I have a $200 credit card, I make sure my balance is below $20 going into that next cycle. After your statement date passes, rinse and recycle. You can spend it or, do whatever you please, but identifying those 2 dates, understanding when you need to pay your credit card, understanding how much you need to carry over or not, will be the saving grace for credit limit increases and growing your credit score.
Let me ask a follow-up. Is it you're supposed to pay off the full balance or leave a little bit on? Because some people say you're supposed to leave a little bit on the credit card every month.
So that's a great question, and I'm glad you asked that. I pay my full balance off by my due date, so I'm not charged interest. However, I do carry over 1% to 3% on my statement date.
Why?
If you report a 0% utilization, sometimes the algorithm could read that as you don't have a credit card, one, or contrary to popular belief, lenders don't like when you don't use your credit card. Like they want to see usage, because that doesn't, if you're not using a credit card, that doesn't really speak to your money management or financial management skills. It just shows you don't use it, right? So if you leave a small balance, it shows that you use it, but also shows that you pay it back.
I think that's a very common misconception. Mm-hmm. And I had to realize that, like, I would use the card, or even for the company, I would use the card, pay it down. Mm-hmm. On a personal level, when I did it, I watched my credit score drop because it showed that I had zero. I'm like, wait, I thought I'm doing the right thing because I have nothing, but it shows that there's zero utilization there. But let's stay on utilization. When is it a good time to now ask for a credit increase?
Ooh, my favorite. Depending on the bank, I ask for a credit limit increase every 91 to like 120 days. Like I'm getting, on all of my credit cards, I'm getting multiple credit limit increases a year. But you have, like, so my sort of trick, or not trick, but what I advise of people is, if you know you have a card that can obviously grow, because you have some cards that they just won't give you they won't give you an increase. they'll give you an increase, or they may not give you an increase, or it'll be like very minimal, right? So if you're dealing with, like, am I able to say companies' names?
Yeah.
If you're dealing with what's considered the top 3, which is Amex, Chase, and Citi, they're going to give you a credit limit increase. However, you have to make sure that 60 days prior to until you're asking for that increase, you are feeding the algorithm. Number one, make sure you have automated payment on, right? It could be for at least your minimum payment. Like, it doesn't have to be your full balance. Just have auto pay on, because the system loves that, right? Make sure that you have at least 2 reoccurring charges on your credit card. By the way, any subscription that people have, this is one thing that drives me crazy. If you have Netflix, Hulu, Apple Music, and a host of other subscriptions that we have, make sure those are on a credit card. Like, there's no reason why any subscription should be from a debit card, because that's a wasted opportunity to have reoccurring charges on your credit card. Having at least 2 reoccurring charges, having auto pay set up, making sure you do at least 10 transactions within that month. And also, like I said, making sure you pay on time. Do that for at least 60 days, so 2 billing cycles, and then you apply for an increase. But if you have a card and you're not using it, you're not going to get a credit limit increase, no matter, regardless of how high your credit score is. A lot of banks will not give you the increase simply because you just don't use the card enough. Because that's actually the number one reason for credit limit increase denials is low usage on the card.
So, okay. How can you avoid pitfalls with credit cards? Because obviously a lot of people fall into issues. Obviously, just don't spend too much. But, what are some ways where it's like best practices as far as using credit cards the right way?
Yes, that's a big one. And to be completely honest, like I tell people, credit card is not an extension of your money. It should replace the money, like your bank account, right? So I am a person that lives off my credit card. And when I say live off my credit card, I mean all of my daily expenses or anything that could be on a credit card, I use my credit card for because I want the points. I want the usage and all of that. However, I make sure that I pay it back. That's the thing. Do not spend, if you don't have it in your bank account or know you're not getting it in your bank account within the next 2 weeks, you don't have it to spend, regardless of if it's a credit card or what. The only exception is if it's like an emergency, like if you just can't help it, you have a true emergency, not shopping or anything like that, then it's really easy to manage a credit card as long as you're not looking at it as if it's an extension of your money. It's not. You have to pay it back. And it's just like, that's where checking your financial habits will come into play. A lot of times people will improve their credit, get access to these high limit cards, and then they find themselves in the hole deep because they can't manage their money properly. They go out and spend, and I realizing like you got to pay that back. So yeah, you just got to make sure that you're not looking at your credit card limit as your money, because it's not.
Yeah, that's often the mistake that we make, and you do that at a very young age.
Yeah.
But there's an importance of having credit at a young age. Like you said, one of those factors is the credit age, right? And so if we're getting credit at 20, 23 years old, we've missed some years that we actually could have. So talk about the importance of establishing credit at a younger age, maybe talk about authorized users and things like that.
Yeah, absolutely. So for the parents out there, I recommend every parent, if you can, if you have a credit card that you're not going to, pay late or whatever, and with good history, I recommend to add your child at no later than 17. Now, if your child is 18, obviously you can add them, but adding your child from the ages of 16 through 17 will set them up for when they turn 18, they'll already have an established credit profile. Most people don't realize that you do not have a FICO score just because you turned 18. You have to have 6 months of credit history with at least 2 accounts before FICO will issue you a credit score, right? So as opposed to just starting at 18 and building your own credit, if you have a responsible parent that will put you on their credit card at least 6 months prior to your 18th birthday, you'll already start off, a little ahead of the pack, right? So as opposed to getting those entry-level credit cards, sometimes you can get quality offers because it's really easy to get a 700 credit score, especially if you have no collections or you haven't messed up your credit yet. It is super easy to get 700. So adding, if you have the opportunity to be an authorized user on a family member's card, and if you share an address with them, it's better because nowadays the anti-abuse laws affects trade lines, authorized users. And so if you have the same address or the same last name, you'll be more credited for those accounts, right? Or for the authorized user accounts. Once you turn 18 though, because this is the mistake a lot of parents make, they'll put their child on their credit card at like 15, 16, whatever. And then whenever they turn 18, the child will have like a 700 credit score. And as opposed to making the child or having the child apply for their own accounts, they just kind of lean on mom's card or mom's credit history and think that it's going to take them far. And that's where they run into the situation of having a high credit score, but not a lot of credit, not a worthy credit borrowing, right? Mm-hmm. So you need to make sure that when that child turns 18, like on my children, on their 18th birthday, we're going to be applying for a credit card. On their 18th birthday, because the earlier the better. Apply for a credit card. Please apply for a credit card before a student loan. That's just like a side note. That's one of the mistakes that I wish that I can catch with a lot of people. Having a credit card be your first established account your credit age is going to be reliant on that account. The great thing about credit cards is they can be open forever. Like, there is no end date to a credit card unless you choose to close the card or the bank chooses to close the card. Whereas a loan, every loan has a term date. Every loan will end eventually. So when your credit age is based on a loan, once that account closes, your credit age is going to be affected drastically, right? So if you have your first established account as a credit card, that's sort of like a safety blanket for your credit age. And so make sure at 18, apply for a card. It can be a secure card. It can be a subprime card, whatever. Apply for a credit card and then start to build your own credit history, because authorized users can only take you so far and not very far nowadays.
Just a quick follow-up, because you did bring up closing cards. And I know a lot of people, as they're trying to fix their credit, are like, all right, well, I paid it off. Let me close it. Talk about like how that could negatively affect your score as well. Yeah,
it could. My rule of thumb when it comes to closing credit cards is if the credit card has an annual fee, and you're not getting any increases and it's just not worth it to keep it, there will come a time where you'll probably want to close that card. When you close that card is super important. Number one, if you are applying for any large purchase like a car or home within the next 6 months, it's not the time to close that card. Close it after you get your car, your home, whatever. The only time I would suggest you closing a credit card is if you know, like I said, 6 months free of any applications. And also make sure that you have another card before you close that card. Like, do not, like, I see people all the time, like, I just hate this card, I want to close it, etc. And it's just like, that's going to do more harm than good. I have a $200 Capital One card that I've had since college. That card is still open. I haven't gotten an increase in years. I don't even care to use the card. I keep it open specifically because credit age. An aged credit card is the most beneficial thing that you can have on your credit report. That, like, the most. And it's one of those things that's like the gift that never stops giving, because every single 3 to 6 months that a card ages, it's going to add more to your credit age and also your FICO points. So keep that in mind. So don't close a card unless you have to. If you have a card that you don't use, put a subscription on it. I have Netflix, pick one of your subscriptions that you probably have coming out of your bank account, assign those to each of your credit cards so that it can have usage, so the bank will not close it due to non-usage.
So what about putting your child on the credit card?
Yeah.
As a child.
Yeah, one of the things that people think that makes a difference is if they add their child at like 12 or 13. That doesn't make it, regardless if you add your child at 12 or if you add them at 17, it will not make a difference in terms of the effect that it'll have on their credit reports. That's a misconception. However, me personally, I would suggest, like I said, adding your child at like 17. When someone adds their child at 13, to me, it just, that's what, 8 years until they turn 18. And that's a lot of room. It leaves a lot of room open for a mistake. What happens if you get a late payment on that card? And now your child's credit will be affected before they can even establish credit. So we never know what can happen, right? So I just recommend, I'm adding my children at when they turn 17. As long as you have 6 months before they turn 18, they're fine.
Yeah, I was a beneficiary of that.
Ooh.
So I was added to my mom's, I told this story before, but I was added to my mom's American Express card at 17. And so now even when I get the cards, it'll say member since 85, even though I was born in 82. But my credit history goes back that far. So it's over 37 years. So every time I get a new card, it gets averaged into that. Yeah. And so I think
that's a blessing. Ooh.
It was a blessing, and that it's still a blessing, actually. I still have the card because I just want that history, because
for sure.
that 37 years plus a 1, they average it, makes it like 16 years of credit age. So I'm like, that works perfectly.
And American Express is a huge relation bank. Like,
Indeed.
Man,
Indeed.
Having a long-standing relationship with them, you can get anything.
This is true. But we talked about the number 700, and it's key. And I don't want people to, some people may not have a 700, but it feels like that's the goal. But there are people, like, what are the numbers that in the range that people should be trying to get to? 700, 750? I know we got some 850s out there.
Yeah, so I'm a little different when it comes to credit scores, right? Okay. Because I know the scoring model and how much your credit profile matters. Most people don't believe me when I say I had over $100,000 in credit card limits before my score was 700, right? And that was simply because I learned how to set up my credit profile that far past my credit score. There's a lot of people who have over 700 and still can't get approved for over $10,000, $20,000, right? Because their borrowing power does not match their score. So I don't ever recommend a specific score. What I will say is, like I always say, a healthy profile will translate. People need to focus on their credit profile more, meaning making sure you don't have any late payments. If you do have late payments, try to rectify those. If you have collections, try to rectify all of your credit issues. Make sure that you have at least 4 accounts open at all times. Like, after you begin to build credit, there should never be a time where your credit profile goes below 3 open accounts or goes below 4 open accounts. Anytime, regardless, you can have an 800 credit score. If you do not have at least 4 accounts open, any application that you do, you're going to get what's called an empty profile penalty, right? And we don't see this as consumers. We can't see this on our credit score or our credit report. However, when it comes to lenders and how our credit reports are assigned and how they translate over to their system, if you have less than 3 accounts open, 4 accounts open, then regardless of your score, you're automatically penalized. You're automatically moved down to a lower tier of borrowing power. Multiple tiers, rather. So that's going to be more important. Making sure you're not applying for let's just say an American Express card if you have just opened up 2 other credit cards in the last 6 months, right? So those are the things that speaks more to like your approval. Now, when it comes to score, if I had to say, I would say 680 and above, you pretty much, with a healthy profile, you pretty much can get anything.
680, okay.
680 and above. And it's super, and the thing is, it's so, and I know this probably sounds far-fetched to a lot of people, but it's so easy to get a 680. Like, I actually tell people, if you don't have at least a 650, then usually one of 3 things are the case. You had a recent collection within 18 months, a recent late payment within 24 months, or you have high utilization. Because as long as you don't have those, you should at least have a 650, just in terms of how our credit scores are allotted.
So, okay. So let's talk about some myths. What about buying trade lines? Is that a way to improve your credit score?
So it's a way to improve your credit score, not borrowing power most of the times. Like, there in 2000, I want to say 9, if my memory serves correct, there was something called the anti-abuse law that came, that released, right, pertaining to FICO scores. And what that is it's because people had overdone the trade lines and purchasing trade lines and trying to piggyback off other people's credit history that were not like family. What happens is, if you do not share an address with a person, if you don't share a last name, or basically if the system thinks that this person is not related to you, it'll automatically omit that card from your score. You will see it on your credit report. You will see, and Credit Karma is probably going to have you believing that your score is a lot higher than it is. However, within the algorithm, it's not going to credit you for that. So I personally don't recommend buying trade lines. There's just so many other things that you can do with the money to build your own credit profile. Okay.
What about credit repair? A lot of credit repair companies and different tactics. Some people report fraud on their thing, saying like they didn't use the card for this, and that's like a way to kind of get credit. So what's some of the myths about credit repair and credit repair tactics?
I can go on and on about this topic. Because I am in a credit education space, especially online, my timeline is usually filled with a lot of like videos about credit and credit repair specifically, right? When it comes to credit repair, number one, let me just say this. The worst thing you can do when you are challenging accounts on your credit report is say that account was not yours. This account is fraud. This account does not belong to me. This account belongs to X, Y, and Z. That is the worst type of dispute, simply because that's the easiest thing for the credit bureaus to prove. So the second that and not only that, as long as they can prove, if you're claiming that this account is not yours, if the credit bureaus can prove that this account is relevant to you, and all they have to do is match 3 points of information. It could be your last name, your zip code, your address. as long as they can match 3 points of information to that account, not only have you ruined your chances of probably ever getting that account deleted and removed, you also you can't re-challenge it. Like you remove yourself from being able to properly challenge an account or challenge your credit report because you lied, essentially, right? And also, like I said, it's a very easy thing for them to prove. I would never suggest that you challenge your credit reports that way unless it's true fraud, especially because there are so many other ways that you can challenge it legally, ethically, and also that abides by the consumer laws, and that'll increase your chances of actually getting the account removed or fixed.
So what are some of those ways?
Number one, I personally recommend, because I do teach, I hate to say credit repair because like I said, I don't even like the stigma attached to it. However, when it comes to your credit report, I am a firm believer that you are, and a consumer laws tells us this, that you as a consumer, we have the right to request validation for every single account on our credit report, right? Now, the accounts that you want to request validation from are typically going to be like the negative ones, right? If you have any collections, if you have charge-offs, if you have late payments, challenge the validity of that account. Simply, all you have to do is ask for an investigation. That's just under FCRA 611. The first letter should always be, hey, I'm requesting an investigation on this account. Never make assumptions or accuse the company of anything, especially not the first round, right? You just simply say, hey, I want you to investigate this account and let me know what you find. I have a few reasons to believe this account may not be all the way accurate, so investigate it for me, right? So as opposed to saying this account is not mine, all you're simply doing is making sure that it is accurate. Just because an account is yours doesn't mean that it can't get removed legally. There are 37 other things that can be wrong with this account per the Metro 2 compliancy laws, in terms of credit reporting, that can legally get the account removed, and even if it's your account, right? So ask for an investigation. Once that comes back, and the credit bureaus will typically say like, hey, we investigated it, we verified it, right? You just assume that they're going to do that because they do. The second round should always be following up on your investigation. Again, FCRA 611, Section 611 tells us that if we do not agree with an investigation request, we can ask for a reinvestigation. The thing with a reinvestigation is now you can request proof. Now you can say, hey, I don't know if this is all the way right. So as opposed to you just telling me that this account is verified, I need proof. If it's a collection, I need a letter from the original creditor that claims ownership over the collection agency, that shows that they transfer that ownership, right? A lot of times collection agencies can't produce that. A lot of times, 90% of the time, collection agencies don't actually have all of the information that they need to properly validate an account, right? So challenging that aspect of it and challenging paperwork will usually get you a deletion legally, and you don't have to worry about, oh my God, when is this account going to come back, or things like that. Like, you don't have to worry about that. If you challenge it properly, then it's fine.
Can we stay in that vein?
Yeah, for sure.
It's kind of like a two-part question, and maybe it's a myth, and you could probably debunk it. But what you're speaking on, if it doesn't come off, then it becomes a derogatory item on your credit, right? So like we talked about late payments, we talked about collections. Talk about the timeline, right? Because people were like, well, I made one late payment, but like from my understanding, that late payment stays on the report for 7 years, right? Is that still true? Like,
it's true. Okay, that's a good question. So, late payments. A late payment is going for the life of that account on your credit report. As long as that account is on your credit report, that late payment is going to be on that account, right? However, the last 3 years of our credit profile is what's most impactful on our credit scores, right? So if you have a late payment, number one, you should be asking for a goodwill adjustment from the company if the account is still open. That's the first step. Hey, you go directly to the company. Hey, I made a mistake. I got a late payment. Are you able to forgive this late payment? If they forgive it, then it'll be as though it never happened. They'll update the credit bureaus. The late payment is going to be removed from your account or from your credit report, and you'll gain all the points back. If you're in a situation where you can't get your late payment removed, here's the thing. One late payment equals 11 on-time payments, right? So to undo the impact of that one late payment, you need 11 on-time payments in the same category. So if it's a late payment on a credit card, until you get 11 other on-time payments on credit cards, then you're not really, like, the points will just be gone. The credit profile, the damage that it does to your credit profile is going to still be present. it cancels out one another essentially once you get 11 on-time payments. So if you're a person who has 10 late payments, your goal should be making sure that you, for the next 11 months, or basically I just say the next year, hopefully no late payments ever again, but you know, 11 on-time payments cancels out one late payment. So
that's great. So this is the other part, because we talk about the things that credit can affect, right? Obviously your score, but it could affect loans and sometimes employment.
Yeah.
But it also can affect relationships. This is important, right? Because you said you need to have maybe 3 to 4 items on your credit report. And some people, when they're in relationships, we've seen, I'm going to get a car, I didn't get approved. Can you co-sign?
I love this. Y'all asking a good question. This is why,
we've been known to do it a few times. So talk about that. Yes, co-signing could be very detrimental.
So one of the things that I do in my day-to-day is I'm a credit specialist specializing in mortgage scoring, right? So I deal with a lot of people who can't seem to close on their home, who need a few more points to obtain a home loan. Now, this is one of the things that I see so much, and we need to change it. So when it comes to married couple spouses, make sure that the accounts are evenly distributed, right? So make sure that one spouse does not have is not the primary account owner of all of the accounts, and then the other spouse, usually like the stay-at-home spouse, is just co-signed on all of the accounts. There is something within the Credit Card Act of 2009 that says on every credit card application, legally, you can use what's called household income. So if you have a spouse that maybe does not make a lot of money or, stays at home, as opposed to them just being a co-signer and authorized user on all of spouses' one accounts, they can apply using the income. They can apply using their spouse's income. So make sure that they still have credit cards, not home loans, but loans and installments in their name as owner, because when you only have co-signed accounts, authorized user accounts, then you're never going to unleash your true borrowing power because it's based on someone else, regardless of who it is. So make sure, yes, I'm glad you asked that question, because that happens so often. Like it'll be one person has great credit and then one person has subpar credit because they haven't built any credit.
Yeah, and that's if you're married. If it was your boyfriend and you broke up, good luck.
Oh, well, yeah. To speak on that, co-signing, no. I won't co-sign. I'm not co-signing for nobody because that affects you. Like if you co-sign for someone, and you can have amazing credit, if they choose to not pay it or, run up your card, you are responsible for that. Yeah. When it comes to co-signing, when it comes to authorized users, they don't have any legal binding to that account. So they can run it up, they can spend every dollar, and it still is going to be your fault. When you co-sign for someone, that if that account goes derogatory, it's going to affect both persons' credit report. And you can't do nothing about it.
So what about credit consolidation? Is that always the most beneficial way to kind of manage multiple?
No, it's not. That chips away at your credit age drastically. So, now it like when it comes to like student loans and things of that nature, sometimes that it's worth it, right? But when it comes to just consolidating your everyday credit cards, I don't always recommend it unless like you're just trying to prevent bankruptcy or something like major like that. But consolidation, I'm not the biggest fan of, just because it doesn't really aid to you improving your borrowing power.
So if people have bad credit and they're trying to improve their credit, what's the steps to actually go from, having issues, bad credit, to having better credit?
Yes. The good thing about having bad credit is you have a lot of points that you can obtain. Like the lower your credit score is, the more points you can grab, right? So my favorite thing when helping someone with their credit is when they do have a low credit score, because it's so easy to get those points. You just have to understand that obtaining those points will not come from just repairing your credit or disputing your credit report. It's going to come from building credit. That is where the points are released from, right? So making sure if you have bad credit, if you have collections, charge-offs, whatever, there is nothing that will help you other than building credit, making sure that you have those 4 accounts, 2 credit cards, 2 installments, 1 short-term, 1 long-term, making sure you do not pay off that installment early, the short-term installment specifically, because you want to build credit, right? Also, if you do have collections, challenging those, right? If they get removed, great. But if they do not get removed, you still can have good credit with collections, because the older a collection gets, the less impact that it has on your score. The more credit that you've established since the collection will help you sort of undo bad credit, right? I think it was 1 account that I could not get removed. And again, that did not stop me from getting credit cards or buying a home and things of that nature, because I had established credit that spoke to my financial habits, my current financial habits, more than those old collections, right? But yeah, so making sure you're building credit. That's what people will say, I have bad credit, so I'm just not going to touch my credit for 7 years. It's the worst thing you can do, because that's 7 years of wasted time where you can build credit. You can come back from collections. I've never, and I have helped thousands. I've looked at thousands of credit reports. I have never seen a credit report that is irreparable, ever. And I didn't seen 300 credit scores. That's the lowest credit score you can get. The lowest score that I've seen, FICO score, was a 311. The lowest, 311.
Right? It goes lower than 350.
No, so the lowest score you can get is 300.
Oh, 300. Oh, okay.
Yeah, the lowest score you can get is 300. The highest you can get is 850. I've seen a 311 credit score.
Damn.
People think that because they have bad credit, they're just doomed for the next 7 years. That's not true. Build credit and you will get credit points. When you add your credit card in the first month that you get a credit card, please, everybody who's watching this, if this is your first credit card, do not allow that first month to be wasted on reporting a $0 utilization. Because a lot of people get their credit cards and they're scared to use it, so they'll just keep it in their pocket or keep it in their wallet. When you activate that card, you typically are going to be mid-cycle, depending on how long your bank took to mail it to you. Go get some gas, go buy some chips, go do something so that you have at least 1 to 3% reporting that first time. The reason why it's important the first time is because when your credit card hits your credit report for the first time, you open yourself up to utilization. Because if you don't have any credit cards, you're not getting a single point out of the 165 points that are allotted for credit utilization. So when you first get your credit card, make sure that you report a very small balance. So the second that credit card hits your credit report, which is usually like 60 days after you get it, you should see a large increase in your credit score.
Yeah, go buy you a pair of sneakers, y'all. So I wonder what your thoughts around this, because we spoke about student loans a few times, and I feel like we're on the cusp of a student loan crisis, right?
Yeah.
We had a student loan pause. Now people have to pay again, and obviously there will be defaults and there will be forbearance. But that's a trickle-down effect, right? Because if there's a student loan crisis, that would mean that there will be a credit crisis too, because that will impact people's credits, and that will affect how people will be able to get home loans, which will have a housing crisis. So from your standpoint, in the middle of it, right, with the credit piece, talk about the importance of student loan repayment, and what we can do for that population, and not even that population, but everybody. There's 43 million people who have student loans. Yeah,
studies show that I want to say 83% of people have credit or have student loans on their credit reports, right? So it basically affects all of us. When it comes to student loans, I know a lot of people always like, I want to get my student loans deleted. They're messing up my credit. The thing is, your student loans are actually probably helping your credit way more than it's hurting it. The only time it hurts it is if you have like multiple late payments. But a student loan is like one of the easiest accounts to utilize to build credit, because most people are in deferment majority of their student loan journey. And if the thing is, your student loans are not going to be reported late until you're at least 90 days late. The thing about that is 90 days late is 3 consecutive late payments. So the second that you even realize that you are late on your student loans, you're down 3 late payments. So that's a hard hit to your credit score. When it comes to your loan service, if you contact them and work out an agreement, get on deferment, nothing's wrong with deferment, then you will avoid a late payment. But as opposed to like paying off your student loans, I'm in the middle about that, because, a part of me, I know a lot of people are upset about, we were promised the $10,000, $20,000. A lot of people were banking on their student loans being forgiven and all of that. So they, didn't think that they would have to pay it. But the thing, if you have student loans on your credit report, make sure that you are contacting your servicer and getting on a deferment plan. They're not going to deny a deferment. Legally, within the next 12 months, if you request it, they have to give it to you. If you have a federal student loan, request deferment before your account goes 90 days past due. Actually, next month, a lot of people, unfortunately, will probably have late payments on their credit report because it's been 90 days since the pause ended. So calling this month though will prevent it. So again, if you have not contacted your servicer, if they have not reached out to you, make sure that you're in contact with them before January, basically, so that you can avoid that late payment. But student loans really help because a lot of people get student loans when they turn 18, and they'll have it forever. Most people have it forever, and that's fine. As long as your student loans are in good standing, it won't prevent you from getting anything.
So let me ask you this: as far as the people trying to recover from bad credit, if they're overwhelmed with credit card debt, what are some options? Can they call to negotiate a settlement? Can they call and negotiate better rate? Obviously, bankruptcy. But if you're just in a situation where you can't get it paid down, what are some options for people?
So when it comes to credit cards, if you just can't pay it down, well, number one, you have to make sure that you stop using the cards. Stop, buying things so that you can manage it properly. Number two, it's so tough right now because we're in a time where credit card interest rates are the highest that they've ever been, ever. So a lot of people with credit card debt is just mounting, it's just growing every single month. So the best thing you can do at this point, if it's just out of your control and you do not foresee yourself being able to pay that credit card down within the next 90 days, the best thing to do is honestly to close that card right now so that you can then work on a payment plan. Now, don't close it and then forget about it and not contact your bank. No. Close it, but have a plan to work out either a settlement with the bank or an agreement to pay it back. If you close it and do nothing, then it'll probably end up a charge off within 30 or within 60 days. But closing it so that you can stop the charges temporarily, stop the interest a little bit, and work on paying it back. You can. I would say you can, of course, get another credit card. You can transfer that balance, but most likely, if you are in credit card debt, you probably don't even have the borrowing power to get another credit card to transfer the balance to a lower interest rate card. So yeah, you can settle with banks, and now a lot of banks are and tax time is coming up. So banks settle tremendously during tax time. They bank on that time. So now's the time to try to, come up with a conclusion on how you're going to settle your balances, and, rectify your habits. But yeah, you can settle, but you got to know that you will have to pay it.
Yeah, I actually went through that as well. Reached out to a bank. It was, I think at one point I was late or something. Maybe I think I had utilized the credit card to the max, and I was late, and they raised the interest rates from 19%. This was my college credit card. It went up to 29%. Then it became just ridiculous. I looked at the payoff date. It was it seems crazy now, but it was 2035, and this is the year 2000. I'm like, all right, house. Yeah, I'm like, there's no way this is gonna happen. Yeah. So then I called, and they consolidated it down to a point where I had to pay it off. But I just had to make sure I paid 6 consecutive payments, or 7 something at the same. Yeah,
usually it's
amount.
6 to 9 months.
Yeah. So when it comes to things like that, when we're trying to pay off debt, because there's been different strategies, and I wondered if you have one, right? Do I pay the card that has the highest usage, or do I pay the one that has the least usage, so I pay that off and then I work my way, the snowball effect? What's your thoughts around that? So
that's a great question. I do like the snow. So if your goal is to just get rid of your credit card debt and you don't really care to raise your credit score at this time, if you're not trying to use your credit, then the snowball effect is probably the most effective. Get the credit card with the highest interest rate, pay it down, and then work your way down, right? However, if you are still trying to use your credit and want to grow your credit while you are paying down your utilization, then I personally recommend look at any card that has a utilization over 48%. Tackle those first. If you can get all of your cards under 48%, then you don't have what's called the max out penalty on your credit score, meaning when you apply for credit, it's not showing that you have a card that's maxed out, right? People think maxed out is 100%. After 48%, banks are looking at you like you have a maxed out card. So get all of your cards over 48%, under 48%. Then the next tier that you should aim for is under 30%. So once you get all the cards under 45%, work to get them under 30%, and then you just work your way down if you care about your credit score.
What's the penalty at 48? Is it points?
Points for sure. Okay. So basically, depending on how many cards, any cards that you have over 48%, and depending on the score that they're looking at, I'll say homes. I'll use the mortgage scoring. Every card over 48%, you're going to you basically should minus 15 points per card from your score, and also if you have cards that are or 30% to 45 or 30% to 47%, you pretty much need to subtract about 10 points per card, right? Mortgage points. So yeah, the 48% when it comes to credit cards, it's showing that you're maxed out, right? So get all of your cards under 48%, then get them under 30%, and then, work your way down if you care about your score. But if you just are concerned with ridding yourself of credit card debt, as fast as you can or the cheapest that you can, then yeah, the snowball effect is probably the one that makes the most sense, because the interest does continue to build, of course, on credit cards.
So, let's talk about business credit. What's the difference between personal credit and business credit as far as how it's looked at for your credit score and how you get it and stuff like that? Yeah,
so most business credit cards or loans are not solely it's not based on your personal credit score. It's based on like your business profile score. And so there is a way to build your business score, but it is different and separate from like your personal credit score. What I tell everyone, make sure, because I find a lot of people, especially in the industry, that will only care about their business score, but then like just don't care about their personal score, which to me, it's backwards. If you have a great credit score, personal credit score, then it also sets you up to have and build great business credit easier. Like, I have never had any of those net 30 accounts that people recommend. I don't deal with all of that, but I do have a lot of business credit extended to me simply by using my personal credit. People always say, like, you don't want to PG your personal credit. I personally do not subscribe to that theory. If I have great personal credit, you absolutely can. I can definitely vouch for my business credit with my personal credit, because number one, lower interest. Like, if you are just going solely off your business credit profile, you're going to pay higher interest for pretty much everything. If you PG it, most of the cards that PG, it's lower interest.
PG, personal guarantee.
Personal guarantee, yeah. And so also establishing personal relationships with companies, like we talked about American Express, that's you can get you have an American Express personal card. Now you can get an American Express business card. Same goes with Chase. Same goes with most of the big banks. So, I personally build business credit on the back of my personal credit, and that does not mean that they're reporting on my personal credit profile. It just means that when I applied for that account, they looked at my personal credit, and I have no problem with that because good.
Go ahead.
Right.
So I wonder from that aspect, when they look at your personal profile and your business profile, do inquiries work the same? Because I know a lot of new businesses will apply for new credit cards, and so they look at the same, and how does that work? Are they negative? Are they derogatory if you have a certain amount within a year? So
are you referring to, like, if you do PG it and they do run your personal credit and it's for a business account, are you saying does those affect?
Well, I know if I apply for like 5 credit cards, which I wouldn't, but
business
if I did,
or personal?
Personal first.
Okay.
Right. Okay. So if they would look at as too many inquiries within a certain amount of time.
Right.
If I have a business and I'm applying for credit cards, do those inquiries, is it looked at the same?
No, it isn't looked at the same when it comes to business, because most of the times, like, the funding requirements are different. Okay. And but however, when it comes to your personal credit card increase way more than installment increase. So if you're applying for a car, you can apply, like, if you go to a car lot, they'll run your credit like 20 times for most people if you don't come already with your financing. Those are not counted individually. A lot of people freak out when that happens, but if you're applying for installments, loans within a 14-day time frame, there is something that's called deduplication, which all increase of the same manner will be basically you're only going to be affected at the weight of 1. You'll see all of them on your credit profile, but they're not all individually impacting you. Now, when it comes to credit cards, they're the worst type of inquiries because every single credit card inquiry does impact you the same. But I mean, here's the thing. Inquiries are only worth up to 55 points. So I tell people all the time, people worry about inquiries more than they worry about payment history, credit utilization, credit age. And it's just like, you should not be trying to save or protect your credit inquiries more than you are building credit. Like, because a lot of people will not build credit because they're scared of inquiries. And it's just like, so you're going to, you care more about 10% of your credit profile than collectively 75% of your profile. That doesn't make sense. When you're building credit, you're going to get inquiries. I don't care about inquiries ever. Because if you have a great credit profile, they will never affect you. There has never in the history of ever was someone denied solely for inquiries. And people convince themselves that the inquiries is what caused the denial. Like, no, you were denied because you have a late payment or X, Y, and Z. A bank is not going to deny you solely because of an inquiry if your credit profile qualifies for the card or account. They would be crazy. A bank wants you to, of course, borrow the money from them. And if you are denied for an inquiry, you can always get a reconsideration.
So, how many credit cards should you have?
Depending on your goals. So for the everyday average person, I would say I always recommend everyone to have an everyday credit card. And that's just a credit card where you put all of your everyday expenses, food, groceries, all of that. So get a credit card, hopefully that has a reward program set up that lends to everyday living, like the City Premier, Amex Gold, or something like that. And then you should always have an emergency credit card. So a card that you can go to for emergencies. You don't really spend on this card a lot. It's solely for emergencies. These are the cards that are best for emergency cards are going to be credit union cards because they have the lowest interest rates. And then you can have a card for just like your personal spending in terms of just like your 3 to 6 month goals or any large purchases, a card that grows. So you really can get by in life with 3 credit cards. I have more, but for the everyday average American, like 3 credit cards to me is perfect.
So when you said that, if I went to Credit Karma and all these other sites, Credit Sesame, Credit.com, they're not going to give me the most accurate number, right? They'll give me a guesstimate. Is the most accurate place to get your credit or track your credit, follow it? Because a lot of people would like to do that. Is it myfico.com?
Yes, myfico or even Experian. And Experian is cheaper.
Okay.
Shout out to Experian. They're cheaper, and you get all of your FICO scores. Okay. So yes.
Yeah. How often should you check your credit?
I mean, you should have credit monitoring active, and there are so many free apps. You can monitor your credit based on your Vantage score. But if you want to know where you stand in terms of FICO, I would say check every quarter at least. Everyone should print out or at least download their official credit reports at least once a year, if not every 6 months. And it's free. If you go to annualcreditreport.com, it is a must that you know what's on your credit profile, especially if you are trying to improve your credit or challenge your credit accounts. Do not challenge solely off credit monitoring. Credit monitoring, whether that's myFICO, Experian, Credit Karma, they only really have a history of the last 2 years of the account. Mm-hmm. There are so many missed opportunities that you can use to challenge that account. If you're challenging your accounts, that is going to be only found on your official credit reports, not on credit monitoring apps.
Yeah, I actually have a credit card that's the subscription to my FICO.
Oh, well, that's good. Yeah. A lot of companies now are starting to offer FICO, which is good because most
$32.99 a month.
Whew.
Yeah.
Yeah. See, I'm grandfathered into the $29.99 plan on my FICO, so I'm like, oof.
She got it early.
They're up to $40 now, though.
Wow.
Yeah.
Can't do it.
Mm-mm.
Well, wealth of information. So talk about your business and how you help people before we leave. I think that's important.
Yeah, so Road to 750 is an online financial education platform. So I specialize in just educating about credit. And through the education of credit, you can utilize those tools to repair your credit and fix it ethically, legally, because that is so important to me to not get caught up in the matrix of what credit repair has become on social media, and trying to find short-term fixes to your credit to just get a credit card. if you truly want quality credit and want your credit profile that'll translate across all of your credit and FICO scores, buy a house and all of that, then follow me at Road to 750 Plus on Instagram. I'm on TikTok, all the sites, and I give free financial education daily, free. If you want specialized help in repairing your credit, then I have Credit Academy, which is my baby, but it is my membership group that I started. It is $39.99 a month, and you will not only repair your credit, but you'll also establish your credit or build your credit or rebuild wherever you are in the process. So we focus on both portions of credit repair or credit restoration, which is repairing, but also building, because you can't do one without the other. So Credit Academy is available. You can go to road to750.net. And just follow me on all platforms. You'll see me down your timeline probably.
There you have it. Thank you for joining us.
Thank you.
And for sure, and thank you for coming to all the events. Something I think the audience definitely got a lot of benefit from every time. So greatly appreciate it.
We appreciate you, Shonda.
And thank you guys for rocking us. We'll see you next week. Peace.
Peace.